Hi, and welcome to the second annual Artisan International Value Stock Pitch Challenge. We're thrilled to have so many of you online today to hear the work of our great value investing program students, and we're sorry that we can't be together in person. Thank you very much to David Samra for supporting this event and for making it possible now 2 years in a row. I'd like to turn it over to him.
Thank you, Meredith. Thank you to the Halburn Center, and thank you all for attending. For those of you who don't know me, I'm a 1993 CBS alum, and I've been practicing value investor continuously, basically since graduation day. I'm a happy sponsor of this event for many reasons, but most importantly, I remember how challenging it was to get started in this industry when I graduated. And this event provides students with three important building blocks to help them meet that challenge. First is the process, the research, communicating what they've learned to experienced investment professionals. Second is the resume builder that you get for competing and as a finalist. And third is the ability to exhibit their skills live in front of you. That may lead to a connection or a job. The winner, of course, gets a fourth benefit, which is obviously the prize money. Before I hand the floor over to our MC, Paul Johnson, I first want to introduce you to our judges and thank them for their participation. The task of vetting these pitches requires the use of valuable time, and all have given very, very generously. In reverse alphabetical order, I'm going to start with Jenny Wallace. Jenny is a founder of Summit Street Capital Management and also a graduate of Professor Greenwald's first value investing class here at the business school. She also is a member of the advisory board here at the Halburn Center. Next is Paul Sonkin. Paul has had a long career in value investing, bridging practice, academics, and publishing. Paul ran his own fund called Hummingbird Value for 14 years. He spent 16 years as an adjunct here at the business school and co-authored a book called Pitch the Perfect Investment with Paul Johnson, who many of you know. James Pan, he's a very close friend of mine, graduated CBS with me back in 1993. He runs a private partnership called CP&E Partners, which was founded way back in 1998. James is one of the most disciplined value investors I know, and he continues to compound returns at very good levels, as he has over the last 22 years. I think Lauren Kruger is probably the busiest person on the panel, so we should all thank her for her participation. She's also a CBS alum and currently a managing director at KKR, working in private credit and special situations. She has a long career in restructuring and distressed investing. She taught here at the business school for several years, serves on the advisory board along with Jenny at the Halburn Center, and sits on the board of directors of more than 10 organizations at my last count. And also, I noticed Lauren is moderating a panel at the SEMA conference, so you'll see her again very soon. Dan Kruger rounds out the Kruger power couple. Dan is a partner at Owl Creek, where he has been since 2002 when he graduated from Columbia Business School. And Dan's talents run across the capital structure, and he served on numerous ad hoc credit and equity committees. Dan is currently an adjunct at CBS teaching a class on distressed value investing, which I noticed was a great way to describe my current investment portfolio. Carl Kawaja is not only a fellow Columbia alum, but also a fellow San Franciscan, also probably of the busiest people that we have here today. Carl is the chairman of Capital Research and Management and has been at Capital Group for 28 years, where he has had a long and very impressive career and track record of investing. Jeff Hume is the person who got me involved in this event, so I have him to thank for that. Jeff has a 25-year career of history of investing, with most of that time spent at Amici Capital. Just a little bit of history. Amici Capital was run by Alex Porter, who is the person that actually founded this event for the second-year students at Columbia Business School. Jeff currently runs his own advisory firm, and he recently finished up his role as the CEO of a listed pharmaceutical royalty company called Innoviva. So as you can see, this is a great group of people. They've indulged us all with their contribution to this event, and I thank them very much. Paul, I'm going to hand it over to you.
Thank you, David, and I very much appreciating that powerhouse of judges that you've all brought together. It's pretty amazing. I have been involved with this event. Hold on, let's see if we can get this fancy Zoom technology to work. You learned to love it. Hey, I've been involved in this event for a couple of years now, and this event is incredibly important in my mind for several reasons. Dave talked about the importance it is to the students, where you get an event for the second year students. There's a Pershing Square, which is the first year event, and a lot of focus. But by the time you're in your second year and you really have started to figure things out, we've not had an event where you can showcase that talent. We also have these fantastic program, the AVI program, and we're producing just fantastic young analysts and investors. And we needed a place to really allow them to show the work that they've developed. So from a student perspective, this made sense. But this event is really important because it brings together sort of almost all of the strands of the history of value investing at Columbia Business School. And I want to walk you through some of those pieces so you can see how this event has unfolded and really been the culmination of 85 years of value investing at Columbia Business School. I too thank Dave. It's actually his third year sponsoring the event, but he sponsored the event in the first year under a different name, and I'll show you all the history. It's kind of fun. All right, so this is actually the 11th event that we've had in this format. It's the third event sponsored by Dave and Artisan International Value. It is held in honor of both Alex Porter and Moon Lee, and I'll explain the relationship there. Dave talked a little bit about Alex's role. The winner is awarded the Sonkin Prize, which Paul donated many years ago. The past 3-year winners, Justin Weiss had a short on Euronet a few years ago. Tyler Red, healthcare services long, and then Alvaro last year had a great pitch on Rolls-Royce Holdings. I'll talk a little bit at the end about how the stocks have done. All right, the history of value investing at CBS. I never tire telling this story. I'm going to tell it fairly quickly. Some of you know it, some of you don't. There really are 4 people that have carried this forward up until the modern era. Ben Graham, which a lot of you know the name. David Dodd, mostly know his name because he was the co-author with Graham of the 1934 book, Security Analysis. Roger Murray, which Paul Sonkin and I are actually writing a short biography on that will be out this year. And then, of course, Bruce Greenwald, which I think almost everybody on the call knows and owes part of their career, success of their career too. Graham is, the father of this all. He graduated from Columbia College in 1914. He was only 19 years old, by the way, and he was second in his class. He was offered scholarships into the PhD program for mathematics, literature, and philosophy, right? Which is pretty standard that you'd have a 19-year-old kid that could do a PhD in all 3 of those topics. He was also offered a 3-year full scholarship to the Columbia Law School. Instead, he went to Wall Street and created a whole new industry effectively. He started writing in his career in the early 20s. He was a terrific writer. Decided he wanted to write a book on security analysis. There was nothing out at the time, but he really felt that he wanted to organize his notes and organize his thoughts. So he proposed to Columbia's business school, which wasn't much of a business school at the time, that he come teach a course. And he started teaching a course in the fall of 1927. There were 200 students in his first class, but 1927 stocks were all the rage. He then taught for 24 years in total. He skipped the war years, 1940 to 1944. He and David Dodd finally published their book in 1934. And then Graham wrote a simpler version of his thoughts in 1949, The Intelligent Investor. And by the way, it's The Intelligent Investor that really got Buffett interested. I'll tell a little Buffett story in a minute. Graham's students are the who's who. Warren Buffett, of course, we all know. Robert Heilbrunn, who is the sponsor of the Heilbrunn Center. Bill Ruane, Irving Kahn, and Walter Schloss. David Dodd, somewhat less known, he began his career teaching in 1922. He was a young PhD student in economics and finance. And when Graham came to the school to teach, he said, I really want a TA, somebody to help organize my notes. And they assigned him David Dodd. He and David worked very closely together from 27 until they finally published in 1934. Interestingly, David Dodd was the associate dean and the head of admissions at Columbia when Buffett applied. And the funny story Buffett tells is that when he found out that the David Dodd who was head of admissions was the same David Dodd from Graham and Dodd, he got very excited and was very excited to come to the school. Roger Murray had a long career as an investment professional on Wall Street, all for Bankers Trust. He'd worked for 24 years. And he was recruited by Courtney Brown, who was the dean of the Columbia Business School, to help Courtney turn around the business school and really beef up the curriculum. And so Roger starts teaching. He's got an investment background. He starts teaching Graham's class in 1956 when Graham retired. Murray went on to have a great career. He retired finally in 1977. And he had a couple of fairly famous students that you probably all know: Mario Gabelli, Leon Cooperman, Art Sandberg, and Chuck Royce all took his course. In the early 90s, late 80s, early 90s, Mario Gabelli was worried that Roger, when Roger died, with him would go all this institutional knowledge and all this history of value investing. So Gabelli asked Murray if he would come give some lectures, kind of an oral history that was taped. And so Roger Murray gave 4 90-minute lectures on 4 subsequent Fridays at the Museum of Television and Radio in Midtown, New York. They were all sponsored by Mario Gabelli and GAMCO. And those become a very important event, which we'll tell you in a minute. Part that's interesting is he's 85 years old, and he taught for 90 minutes each week without any notes. Attending the event was Bruce Greenwald, which becomes important, Mario Gabelli, of course, and then none other than Dave Samra, James Pan, and Jason Leder. Bruce is recruited from MIT in 1991, and he comes in to teach primarily economics and strategy. He's promoted to the Robert Heilbrunn Professor of Finance and Asset Management in 93 because he launches the value program that year. He attends the Murray lecture, as I just said, and he's so impressed by the logic and the presentation that Roger gives that Greenwald decides it probably makes sense to see if he can bring the program back to the school. In 2000, New York Times names Bruce Greenwald the guru of Wall Street gurus, and Bruce retired. We can't tell when he retired. It's either 2018 or 2019. Greenwald had this quote after attending the Murray lectures. Like generations of investors who preceded me, I was struck by the compelling logic of Graham's approach. As a consequence of those lectures, in 1993, I dragooned Roger Murray into joining me in offering a revised version of the value course. So in the fall of 1993, which is a course I think, Jenny, you took, Bruce launched a class called The Fundamentals of Investing, Approaches to Value, an advanced seminar co-taught by Bruce Greenwald and Roger Murray. For the first 4 weeks, the two professors lectured, and they really did sort of the standard accounting balance sheet and asset valuation. And then the last 8 weeks were devoted to famous value investors as guest speakers. Warren Buffett came back, Mario spoke, Chuck Royce spoke, Seth Klarman came back. He had a relationship with Bruce. Michael Price, one of the great value investors of all time. Bob Bruce, who had a relationship with Buffett and with Sandy Gottesman at First Manhattan. Walter Schloss and Andy Weiss. And then the final project for the class was to uncover an unloved or undervalued stock. Both James and Dave sure would have loved to have taken this course, but they had graduated by then. The Heilbrunn Center has really been the pioneer of value investing in the modern era. And history starts in '84. They sponsored an event. This was before the center got set up, but the school sponsored event, very famous event, where Buffett spoke on the super investors of Graham and Doddsville. In '84, David Dodd's daughter, Barbara Lerner, gave a gift and started the whole process. In 1990, they launched the Graham and Dodd Breakfast, which has become a significant annual event. In '93, we had the GAMCO Murray Lectures. In '97, they launched the SEMA Conference, which is coming up next month. In 2002, with a gift to the Heilbrunn family, Robert Heilbrunn had been a devotee of Ben Graham's, as I mentioned. They gave money in honor of his 80th birthday, and we started the Halbrun Center. In 2004, they launched the Value Investing Program for the students. In 2006, they launched the Graham and Doddsville, which is a great, I think it gets published 3 times a year, newsletter published by the students. In 2008, with the support of Bill Ackman and Pershing Square, they launched the Pershing Square Challenge. In 2009, with the urging of Alex Porter, they launched the Moon Lee Prize, which is the precursor of this event. In 2010, they launched the From Graham to Buffett and Beyond Omaha Dinner. And then 2020, they took over this event, the Artisan International Value Stock Pitching Competition, which is really aimed at second-year students. This is just a quick, for those of you who don't know, it's the best investment recommendations that come out of the CBS AVI program. 16 recommendations were submitted, with the top 4 selected by the judges for today's event. It's sponsored by Dave Samarin, Artisan International Value, in honor of Alex Porter, Moon Lee, and awarded the Sonkin Prize. The full history, just so you know, I think this is kind of fun. The Moon Lee Prize ran from 2010 to 14. The Amici Capital Prize, I'll explain how it got name change, ran in 15, no event in 16, and then Jeff Holm kept it alive and brought it back in 17. We brought the event to the SEMA group in 18, in 2019, and then in 2020, it became a Halbrun event, and obviously this year as well. I just want to talk about all the players that have kept us alive. Alex Porter was from a small town in North Carolina, very passionate about investing. I love this. His first job in New York was Jennison Investments. He offered to work for free, and they took him up on the offer. He then worked with A.W. Jones, which was really the first modern day hedge fund. He then launched Amici Capital in '76 with $360,000 from 3 close friends. He had solicited 30, but only 3 came together. And the name Amici was in honor of his friendship. He had very wide-ranging interests. And I love this Kate Welling quote: Alex was a true rarity on Wall Street, a true and generous gentleman, as well as a fine investor, outstanding intellect. Moon Lee had worked at Amici Capital from 2003 to 2008. He also was deeply passionate about value investing, as is everybody on this call. He had been recruited from Goldman to work at Amici. He graduated both as an undergrad and a grad from Harvard Business School, and received a Dean's Award when he was in the business school. Deeply passionate about people and relationships, and unfortunately died in his mid-30s in 2008. Alex Porter approached Greenwald in 2008 about sponsoring a stock pitching contest in honor of Moon Lee. John Freeland, who worked with Alex Porter and a graduate of the program, helped facilitate the event. The Moon Lee Prize ran for 5 years, as I said. Alex Porter died in 2014. The competition was renamed the Amici Capital Prize in 15 in his honor. The competition didn't happen in 16. As I said earlier, Jeff Holmes single-handedly resurrected the competition in 2017. That's when I got involved. I met Jeff at that event. I served as a judge, as did Paul Sonkin. We had been introduced by James Pan. James Pan, who's a judge tonight, he had audited my security analysis course in the late 90s and recommended that Jeff and I meet. Jeff had worked with Alex Porter for 14 years. And during the time that the assets under management grew from 75 million to over 2 billion. And Jeff really kept this thing alive, and we would not be here today without Jeff's support. And I like this, Jeff said to me, he really appreciates the opportunity to keep Alex's memory and his investing career a focus via this competition. All right, Paul Sonkin, who's my partner in crime, co-author on my book, graduated from the program in '95. He was my TA in the fall of '95 and taught his first class in '96, which had this really great short title, Advanced Seminar on Fundamental Research Techniques, Security Analysis, and then taught an advanced security class the next year. With the support of the school, he created the Applied Value Investing course, and then launched the AVI program in the fall of '98, and then taught at the school for 17 years. He funded the Sonkin Prize with a donation of $56,000. And originally it was awarded the best paper in Bruce Greenwald's value investing course. And then it died, and we relaunched it in February of 18 in conjunction with this pitch. Dave Samarin, you've already heard from, and you know a fair amount about. He graduated in the program in '93, shortly after the Murray Museum of TV Lectures. He was president of the Student-Run Investment Club while at CBS. very interested in value investing, has his whole career, but there were really no classes offered. And this is the third year he sponsored the event. James Pan also graduated in May of '93, shortly after the Murray lectures. He audited Greenwald's and Murray's class in the fall of '93, and with Jason Leder, who you met earlier. David already moved to San Francisco, but he would have clearly joined them. James started in value investing as an intern for Merrill Whitmer. He was a short seller for a few years in '93 to '95. He dabbled in international value investing, working with Bill Strong and Amit Wadhwani. And then he was a research analyst for Jeff House and Mike Lowenstein at Tyndall Partners. And then he launched his own partnership in 1998. And as Dave said, he is one of the most disciplined and creative value investors out there. This is where it gets really fun. Dave and James really led to the revival. They were a key element to the revival of the value investing program at Columbia. While they were students, there weren't really any classes, but they invited famous investors to speak at the school: Liz Bramwell, Mario, Leon Cooperman, and Jimmy Rogers, which is really the precursor of the value investing course and the design of the course, and now what we call the Legends course. Dave ran the investment club in his second year, and they ran a stock picking contest with prize money from Gabelli, really foreshadowing this event. And then Dave petitioned the dean with James and Jason to revive the value investing program. Although Dave told me he didn't get an audience with the dean, so he's not sure it really had an effect. But these events all coincided with activities at the school to relaunch the value investing program. Murray lectures are really the linchpin. As I told you, Greenwald attended those lectures, and afterwards he convinced Murray to help him start the program. But Dave, James, and Jason all attended the same lectures. And at one of the coffee breaks, they engaged both Mario and Bruce about offering a formal value investing class with great investors as guest speakers, which was really the design of the course that happened. And he gave Greenwald, I think this was really James, was giving Greenwald a hard time about the fact that no one was teaching value investing in the program, and all they cared about was efficient market theory and beta. That's when they proposed to Gabelli that he invite some of his value investing friends to speak at a new class, and Gabelli loved the idea and Greenwald ran with it. So we're here today. So the culmination of all that is how we get to tonight's event. Last year's winner, Alvaro Pasquin, he had a long on Rolls Royce. The stock was about 235 at the pitch. The stock today closed at 101, down 57%. The number 2 pick, in a very close second, we had a long debate about it, was a short Peloton. The stock was at 30 and it's now at 158, although it did go down to 19 in the initial COVID crash. So what a difference a pandemic makes to investing. All right, with that, I'm going to hand it over to you, Meredith, and thank you all.
Thanks, Paul. So we're going to start with Amitaabh Sahai. It's going to be 10 minutes of pitching and then 5 minutes of judges Q&A. Amitaabh, whenever you're ready.
Good evening, everyone. Thank you very much. And very excited to be pitching today along in DXC Technologies. DXC is basically a provider of outsourced IT services to clients in the US and in Europe. I have a 3-year price target of $66. The company currently has a share price of about $29. So that represents a money multiple of about 2.3x and annualized returns of about 32% over the next 3 years. So just a quick overview of the company. As I kind of mentioned earlier, it provides outsourced IT services to clients in the US and in Europe. Key services include IT infrastructure outsourcing. So basically looking after your data systems, your data servers, server farms, etc. The second service line is IT applications outsourcing. And the third service line, which they've got into fairly recently, is called sort of high-end software engineering services. Just a quick situation update. So since I last presented this deck back in December 2020, on the 7th of Jan, actually, DXC received an unsolicited acquisition bid from Atos, which is a French competitor of the company. However, the offer price has not been disclosed and the transaction terms and timelines have not been publicly disclosed either. So as a result, DXC shares have rallied only about 9% since then. And I think the investment still remains highly compelling at current valuations. So my investment thesis is sort of broadly centered around one theme, is that the company has historically underperformed on account of sort of company-specific issues. They recently had a management change in September 2019, following which revenues and earnings of the company are finally stabilizing. And should that happen, current valuations at about 4.3x EV to EBITDA are just far too compelling, and the risk to reward skew is extremely, extremely compelling. Just a very quick sort of reminder of the company. So it provides outsourced IT services. It was formed back in April 2017, following a merger of CSC and HPE, which is HPE's Enterprise Services Division. As you can see on the revenue split on the left, about 32% of revenues comes from the US, about 43% of revenues comes from Europe, about 30% comes from IT infrastructure outsourcing, 30% comes from applications outsourcing, and the remaining 40% sort of is split across a bunch of other IT services. Also, I just wanted to highlight the shareholder base on the bottom right. It's a fairly institutional shareholder base held primarily by large passive long onlys. But I do want to highlight the shareholder number 9, which is Miller Value Partners. So Bill Miller is extremely long on the stock, and he took about a 5% stake in the company in his portfolio in the most recent 13F. So, the financials of the company present a very sort of sorry story. It's declined about 7% annualized over the last 4 years since the merger back in April 2017. And then finally, after the appointment of the new CEO in September 2019, revenues are kind of stabilizing after, for the first time in 4 years, as you can see on the bottom right of the revenue chart. And this is also reflected in the share price chart of the company. It's been a constant story of over-guiding and then missing guidance. And then finally, after September 2019, the fundamentals of the company seem to be improving. So just going back to my investment thesis, it's basically factored on 4 different factors. The first investment factor, which is also my first variant view, is that the addressable market for DXC's core IT infrastructure outsourcing services is actually more stable than it appears. The second investment factor is that the new CEO is catalyzing a turnaround with streamlined operations, reduced debt, and stabilizing earnings. My third investment factor, which is my second variant view, is that the market is not valuing DXC's highly profitable, high growth Luxoft business, which is an Eastern European company that basically provides really high-end software engineering services. And my last investment factor is that once the first 3 investment factors come together, current valuations of 4.3x EV to EBITDA is just unjustifiably cheap for a company that's this asset light and cash generative. So just delving a bit further into my first investment point, the market for IT infrastructure outsourcing services is sort of a sunset, mature, declining industry. What DXC basically does is it provides manual services and manual labor to look after your IT data systems and your server farms. Now, obviously, with the move to public cloud systems such as AWS and Microsoft Azure, companies are kind of reducing their on-premise IT systems. However, after speaking to multiple CIOs in my primary research, what I've come to realize is that companies are moving to a hybrid IT model, which basically means that it's going to be a mix of on-premise IT systems that they currently have, and then build sort of concentric circles around that in which they move workloads to public cloud platforms. As a result, the industry is not declining the high single-digit rate decline that's feared by the market, but rather it's been flat to low single-digit decline. Instead, the high single-digit decline for DXC has been more due to company-specific issues, as is kind of mentioned in the quote at the bottom. The new CEO in his most recent quarterly earnings kind of said that the revenue runoff was not caused by cloud trends, not by structural trends, but rather due to suboptimal customer delivery. Now, the good news is that is within DXC's control and fixable, and the CEO is doing a very good job of fixing it, as I kind of show in future slides. Just another quick slide on the addressable market for IT services. It's huge at about $1 trillion, growing at mid-single digit rates. And as you can see from some of DXC's comps at the bottom, the outsourced segment of that is about $240 billion, also growing about 4 to 5% a year. So in terms of what the new CEO has done, the first leg of his transformation program is to basically sell non-core assets and reduce the debt load of the company. So he sold 2 segments back in 2020. So the first is a US health and human services business, which he sold at about 12 times EV to EBITDA for $5 billion total EV. And the second business is a healthcare provider software business, which he sold for about $500 million. So the total cash proceeds from these 2 sales is about $3.5 to $4 billion. And he's used all of that to basically pay down debt and reduce net debt to EBITDA now to about 1.3x. Keep in mind that he sold that segment at 12x EV to EBITDA for a company that's currently trading at about 4 times EV to EBITDA. The second leg of his investment thesis, of his turnaround plan, is that he's basically gone back to clients and from the grounds up renewed client relations. So he's renewed relations with 38 of the 40 most troubled accounts. And that kind of echoes in the recent deal wins, where DXC's book-to-bill ratio has been more than 1x for the last 3 quarters, for the first time in the company's recent history. A book-to-bill of more than 1x basically means that revenues in future quarters is going to be either flat to low growth. My third investment thesis is that Luxoft, which is a segment within DXC, is highly underrecognized and undervalued. It's basically grown at 20% CAGR over the last 5 years. It operates in a large TAM of about $150 billion, growing at about 15% CAGR, led by some very strong tailwinds from digitization and rapid tech enablement. And sort of when you look at all these 3 investment factors together, my last investment thesis is that the current multiple at 4.3x EV to EBITDA is just far too cheap. It's the bottom 1% percentile in the S&P 500. And should revenue start stabilizing as it's expected in this quarter, which releases on Feb 4th, I expect multiples to re-rate to my intrinsic target of about 6 times EV to EBITDA. My base case price target for the company in 3 years is $66, which is annualized returns of 32%. My upside is about $107, and my downside is about $28, which is flat from today, which provides a very strong and compelling risk to reward skew of 3.8x. The risks around the company. So first, sort of it's well recognized that there is a decline in the core ITO business. It's a sunset industry. But as I kind of mentioned earlier, my primary research reveals that it's going to be a flat, low single-digit decline and not a high single-digit decline as it has been for DXC historically, which were more due to company-specific issues rather than industry structural headwinds. My second risk point is that there's obviously a key man risk around the new CEO. But then again, I'm kind of comforted there by the fact that 91% of the CEO salary is based on performance-based incentives with sort of golden handcuffs. The third risk point is that there is a large bridge between reported to adjusted numbers of about $600 million in cash expenses, mostly M&A and restructuring expenses, as you would expect for a company going a turnaround. But then again, all of my valuations, price targets, and future cash flows are based on reported numbers and not on adjusted numbers. And lastly, historically, there used to be a leverage risk for the company. The debt load of the company was high at about 3.5x total debt to EBITDA. But then after the sale of those 2 non-core assets, that's really gone down now to about 1.3x net debt to EBITDA, and it no longer remains a risk because now net debt to EBITDA is kind of in line with peers. So just to recap my investment thesis, I think it's an ongoing turnaround company. I would have not invested in this company back in August 2019, but after the new CEO, there seems to be a very strong and very compelling turnaround with very strong green shoots. The market is overly bearish on the overall industry for DXC, which my primary research reveals that it's not as challenged as the market expects it to be. The market is not valuing it's not ascribing any value to DXC's high growth Luxoft segment. And lastly, when you look at all these things together, the company currently trades at extremely attractive valuations of 4.3x EV to EBITDA with a very compelling risk to reward skew of 3.8x. So thank you very much and really look forward to your questions.
Great. If the judges would turn on their cameras and unmute themselves, we'll have 5 minutes for Q&A.
If I may, Amitaabh, could you talk a little bit about the key drivers of this business? So mainly, given who their competitive set is, the cost structure, and the capability of the delivery model, and how that compares to their competitors like Accenture, Tata, HCL, et cetera, who've been obviously the recipient of the market share in this industry for many years.
Yeah.
Thank you.
Sure. So I think the slide, the table at the bottom kind of lays out who the competitors are. So if you look at the set in the middle, it would be basically the IT infrastructure outsourcing peers. So that would be an HCL or an IBM in its managed services business, or Rackspace, Entity Data, and Atos. These are the closest competitors. If you look at Accenture, TCS, Infosys, Wipro, they're actually IT applications outsourcing businesses, which is slightly different from the industry where DXC operates. And IT applications as an industry is not as challenged as IT infrastructure, which is why TCS has grown at like 9% revenue CAGR as a $20 billion revenue company for the last 5 years. So what kind of fundamentally differentiates DXC from these high growth companies is that it focuses more on IT infrastructure services. Now, obviously, that is a more challenged place to be. But the good news is that there is less competition from offshoring because companies actually require you to have your employees at their data centers and their server farms, which are usually onshore in the US and in Europe, whereas applications can be very easily outsourced to India or to Philippines or low-cost locations. which is why, to your earlier question around cost structure, a lot of DXC's employees are actually based in the US and in Europe, whereas for TCS or an HCL, a lot of the employees are based in India, which is why TCS earns like 40% gross margins, where the DXC earns like 25% gross margins because it's got a higher cost structure, but then again faces less competition and less threat of offshoring versus some of its peers. And also just one final point on that, in this peer set, the closest peer would be Atos, which trades about 6 times EV to EBITDA. Atos is basically a flat, low single-digit decline company. And my base case is basically that DXC should become like an Atos in 2 to 3 years in its financial profile, and that should sort of lead to multiple re-rating for 6 times EV to EBITDA as well.
I'll jump in. First of all, great presentation, really polished, and you've obviously done a lot of work. My question is just about valuation. Very low EBITDA multiple. When I see those, I start to think about cash conversion. It looks like the levered free cash flow yield is high single digits, 10%. Is that attractive to you? Is it attractive relative to other companies, or how do you reconcile that part of it?
Yeah. So when I actually pitched this company, and if you look at it on an LTM basis, the levered free cash flow yield at the time was 16%. And assuming, say, a 10% cost of capital, that basically meant that the market is saying this company is going to decline 6% into perpetuity. And I think that was just too high. I think at 10%, and also, if you look at on a forward basis, the free cash flow in 2021 is expected to be very low because of the ongoing restructuring program. This is all on reported basis. Once you look at at least my base case, as you go to 2021 and 2022 and thereafter, the current free cash flow yield still remains at about 15%. And I think that is much too high. Once this company becomes sort of a flat revenue growth company or a low single digit growth company, as I expected to in my base case, then I expect the free cash flow yield to go down to basically its cost of capital, which is about 10%. And that's going to lead to sort of a multiple re-rating there as well.
Can I ask a question? So in the new year, you mentioned that there was a takeout interest,
yeah.
And you also just mentioned that the company should be most like Atos, which I guess is bidder. Any feeling for what they could pay, and still be accretive, or what the combination might look like, or how supportive of that is your thesis?
Yeah, so when I initially made my thesis, it had no takeout point. I did not expect a takeout. I think Atos is probably not the best suitor for this company. And IBM would be a much better buyer for the company, but then IBM is also not focusing on this business as much. It's actually spinning it.
Because of scale, or why?
Yeah, because actually Atos is a smaller company than DXC. It's not in terms of market cap, but in terms of revenues. So in many ways, this might be a merger of equals. So the offer price has not been disclosed, but there's been like a $10 billion value being thrown around. Now, I don't know if that's 10 billion EV or 10 billion market cap. If it's 10 billion EV, then that would actually be less than the current share price of the company. And obviously DXC is not going to say yes to that. If it's a 10 billion market cap, then that's like a 30% upside or 35% upside from where the share price is today. The only fear that I have about Atos is that 10 billion market cap is about 14 billion EV, which might be a touch too high for Atos. And secondly, if it's a merger of equal, then it might be even equity financed. We might get shares in Atos, which I just don't have enough perspectives on the company to be very supportive of that transaction term.
Okay.
Amitaabh, Meredith may cut me off here. It's Carl Kawaja, but I had a question, and thank you for your excellent report. Did you try to figure out the extent to which like some chunk of their revenues go away? Because I know a lot of their business is kind of leasing stuff like hardware that is kind of going to go away. And as I look at their revenue, it looks like that's well more than half of the revenue. So I worry that it kind of looks cheap, but if I thought the revenue was a fifth what it is stated to be, then it's kind of less compelling. Yeah. How do you think about that?
Yeah, absolutely. So they don't recognize any revenues when they lease hardware. They only recognize revenues when they render services. So 100% of their revenues is recognized when they render services. Now, the hardware business is the 30% of the IT infrastructure outsourcing. That's where they actually lease hardware for their clients, basically, data systems and data servers. 43% of revenues, which is a gray boxes up top, are completely asset light. That's all just applications outsourcing. That's just human services based. The cloud and security is all asset light. 16% workplace mobility is all asset light. So it's only that 30% where they actually lease. But again, all of revenues that's recognized there is just T&M basis. One of the employees puts in 1 hour of work, makes a certain $25 an hour. So that's how I thought about that risk.
Okay, so you said sort of 70% of the revenue you think doesn't go away. Because one thing that sort of surprises me is if you look at them relative to like other, outsourcers, their revenues are so high relative to those. Like if I look at their revenue per employee, they're like north of $500,000 or something like that. It's a lot to bill.
Their revenue per employee, I can follow up with you on that. When I had done my calculations, it came to about $120,000 per employee. And most of the competitors are about 60,000. And that kind of ties back to my earlier point, is that their employees are based in the US, whereas competitors' employees are based in low-cost locations in India and Philippines.
So Meredith, I have just one very quick question. I know you want to stop. Can I just ask very quickly?
Sure.
Okay.
Last question.
Okay. It was a great presentation. Thank you. I just had a question about the CEO's performance compensation that you referenced in your deck. And if you were able to ascertain how that performance comp compares to the current performance of the company.
Yeah, sure. So his as you can see on the table here, he's got 70% of his compensation tied up in PSUs. Now the PSUs has a vesting period of 3 years. And for that to work out, the EPS target in 3 years needs to be about $10 a share at the end of year 3. Then this company will be trading at like 3x PE if that actually works out. And so far, he's done a very good job. So earlier the company used to be overguide and then underperform. Now the last 2 quarters actually been a beat and raise situation. And he's actually the CEO. He was responsible for turning around Accenture's BPO business before he became the CEO here. So he comes from a very sort of respected background. Comes from a PE background as well. He worked as an operating partner at a PE fund. It's pretty aggressive targets that they've set for him. So he is pretty incentivized to meet those targets.
Thank you.
Great. Thank you so much, Amitaabh. Next up, we have Eric Sai. Eric, whenever you're ready.
Can you hear me?
Yes.
All right, perfect.
Yeah.
Trying to share my screen and all right. All right, let me know if you guys can see my screen.
You're good.
All right, perfect. Yeah, so thanks for having me tonight. It's an honor to be here after 12 years of kind of legacy of this competitions. And tonight I want to kind of pitch your stock called Johnson Matthey. It's a quite interesting company. I think it's suitable for investors who are looking for contrarian idea and won't willing to pay too much for growth and also look for value to protect the downside. So before I go into my investment thesis, just want to walk you through the background of this business. Johnson Matthey is a £6 billion UK-based specialty chemical business. And they really started as a platinum group metals refiner since 1850s. And since then, the company has been innovatively finding applications of these metals. And in 1970, they ended up finding auto catalysts as the key business because they use platinum group metals to reduce emissions. And today, 1/3 of the cars use their auto catalyst, and over 40% of the recycled platinum group metals go through their refinery. And the company at the same time is finding more applications for these metals in such as health and alternative powertrain segments. So the market perception of this company is really thinking that this is an auto catalyst business. And as a result, as the hype for electric vehicles is going higher, people really worry about this business going away, and as a result, assigning it a very low growth expectation. Currently, the company is valued at 12 times EBIT at around £6 billion. And I think the market is really wrong in 3 respects. So first, the company is actually an R&D platform that commercialize technology around precious metal rather than really just focus on autocatalysts. It just ends up that autocatalyst is the biggest applications that precious metals business. And secondly, when we look at kind of tighten emission regulation around the world, the autocatalyst demand is actually growing rather than declining in the medium term. And that far outpaces the concern that the market has around EV penetration. And lastly, when I look at what the company is investing and growing in the health, battery materials, and hydrogen, there's a lot of new market opportunities that is not being priced in for this company. And as the company execute well with the dominant business on catalyst, as well as delivering some of the market opportunities in the next 5 years, expect this to be a 70% return investment with a 14% annualized return opportunity. So going to the first market concern about battery electric vehicles, when I look at kind of what industry is thinking about the penetration of battery electric vehicles, I see that it is actually going to be about 2%. It's actually 2% right now, selling about 2 million battery EV, and will be about 5 to 10 million in 5 to 10 years. And relative to a 90 million vehicle productions in the world, that's actually a very small amount. And not to mention, when we think about countries that are saying they're going to want to try to do more EV and less internal combustions, that include plug-in electric vehicles and hybrids, which also use autocatalysts. So if we look at the next 10 years, is the total number of vehicles that need this catalyst is likely to grow rather than decline. And on the flip side, when I look at the autocatalyst content demand per vehicle, on the left chart, it is showing you how quickly that content amount per car is growing because of tighter emissions throughout the history. In China, for example, that content growth grew 70% in the past 5 years. And China is the biggest automobile market right now. And when I look at the emission regulation that get implemented in 2020, in both China and India, these content is going to double to triple in the next 5 years. And even in Europe, that standard is tightening and it's expected to grow content by 20%. And together, that implies a 30% top line growth in the next 5 years, even if I assume a 10% battery electric vehicle penetration. So I think the market is already quite wrong about the autocatalyst business. And on top of that, there are quite a few attractive growth opportunities that the company can build upon its core kind of R&D expertise. And one of the medium-term opportunity is the health segment, where the company guided to be able to generate 75 million incremental profit growth from their drugs pipeline, where they have already invested in the past 5 years. And secondly, they're opening a battery materials plant to kind of counteract the market perception that their business is going away. In fact, metallurgy and chemistry is the core competency, and the competitive landscape is very similar to autocatalysts. And in the next 5 years, I expect in the medium term, they're going to generate 15 million profit growth from this new plant that they're building. And in the longer term, if they succeed in this respect, there's a huge upside potential from this new segment. And last and most importantly, I think they have a very strong competitive advantage in the hydrogen market, which I believe will get really big in the long term, even though in the medium term, it's not going to affect profit very much. And that's because they are involved in both the consumption and production of hydrogen. And if we look at the world trying to achieve net zero, they have to use hydrogen, a high energy density chemical, in order to power planes, for example, or heavy duty trucks. And when we look at fuel cell, every fuel cell also uses platinum group metals catalyst, similar to the autocatalyst business. So it plays right into Johnson Matthey's advantage. And on the other hand, when you need to use hydrogen that is produced from clean sources, Johnson Matthey offered blue hydrogen technology already, which is hydrogen technology with carbon capture. And they can sell this just directly to their existing customers, which uses the technology to do hydrogen production right now. And market really hasn't placed any value in any of these new markets. And that is why making this opportunity attractive. So by seeing that the auto catalyst business doing well in the next 5 years and realization of some of these opportunities, both health and new markets, I expect the company will be have a much brighter future in 2025, also have a tangible higher value in terms of operating profit. And that leads to a 10 billion pound EV valuation, plus a 3% annual dividend yielding 14% annualized return through 2025. With that, I'll open to questions and you can bring me to any direction. Thank you.
Thanks, Eric. Judges, you're on.
Eric, thank you. I thought your work was incredibly detailed, so very well done. I have a couple of questions. When you look at your model, the largest driver of returns is the growth in catalytic converters, the amount of platinum in catalytic converters and vehicles sold in Asia. So yep. I'm wondering if you'll just invert your equation here and talk a little bit about the risks to that story. And then while you're talking through, after you're done talking through that, your forecast also assumes the margins go well above historical norms, I think over 16%. And if you could talk us through the reasons why that happens in that core business, and why you don't get deleverage in that business as volumes start to decline in other parts of the world. Thank you, Eric.
Yeah, good question. So let me first answer by answering the risk side of things. So I think what you're paying for at 12 times is really the fair value of the business, the auto catalyst business itself. So I did run in free cash flows in terms of the auto catalyst business as well, and just to see what does the cash flow look like. And that itself turns out to be about a $3 billion business with kind of secularly declining post about 2030. And on the margin side, and that's exactly the kind of same reasoning you talk about. The improving margins mainly come from improvements in operating margins. As when I'm doing the forecast, I'm seeing the contribution margin as kind of the historical average. And in 2020, it was mainly temporarily suppressed due to kind of the shutdown in a lot of factories. And so what I'm seeing here in the next 5 years, the margin improvements really come from that operating leverage from higher 30% higher top line. So lastly, in terms of kind of the risk, now if they distribute all the cash flow back to you, then you're kind of getting the business for 5.5 billion paying today's price. But say right now, obviously they're actually distributing only 40% and they're reinvesting the other 60%. The question is what they're reinvesting into. And what they're doing is actually investing into battery materials plants. That's the main focus of the investment right now. And the rest is kind of R&D scattered across different segments. And the group targets ROIC is 20%. And in the kind of long history, they have achieved kind of 10 to 20% range in the group level. So kind of confident in that sense that this business is actually going to sustain even as auto catalyst goes down. And that's kind of based on the fact that the company is an R&D platform around precious metal. And that's how the company has survived like 150 years. In fact, the company was founded in 1817. And so the company has survived 200 years because they have kind of moved from applications to applications.
Hi, Eric, is very well done. Can I just clarify, what do you think is the main driver of your thesis? Is it the misperception of the catalyst business, or is it the misperception of the growth opportunities?
Yeah, so my view is the misperception of the main growth opportunities, because as you see here, like if we look at their legacy business, it's worth 5.5 billion pounds. The company's value is 6 billion or so. So what I'm saying here is actually you're getting growth for very cheap prices. And why do I think these growth opportunities can be realized is the fact the main kind of convictions come from their competitive advantage in the hydrogen space and their core competitive advantage around platinum group metals. And platinum, unless you believe that platinum group metals or these metals will become useless, the company will always have kind of their space in terms of the downside that protects you from kind of the company from going down, because all recycle volume relies on the refinery. And on the upside, whenever it comes to applications that use these platinum group metals, they have advantage because they control the large volume, and they can, by having a recycling kind of business model, they basically have a closed loop business model where customers kind of buy their products, manufacture it, and then they recycle back the products and get them to get back their platinum bags and redo new products. And that is actually highly recurring. And when I look at kind of the hydrogen market in the future, first, it looks like that's going to be a much bigger market than the auto catalyst business, simply because in the auto catalyst, this is only on the consumption side. But in the hydrogen side, you're also on the production side, which is kind of taking share from oil refinery per se. And second is just this plays right into the advantage again. And that's why I think the market is not valuing this part where you're getting for free. And that's why I think this is a very attractive opportunity.
Can I just ask one quick question?
Sure.
Eric, this is really well done. Thank you. On your first variant view, which is this sort of threat to the auto catalyst business, are you saying, just to clarify, that the market perceives this as a declining business? You anticipate that it will decline slower than the market, or are you anticipating growth in its base business as well?
Yeah, so good questions. I'm anticipating growth in their business in kind of the foreseeable, at least next 5 years. Is very obviously they will be highly profitable in this period just because of the higher content, higher volume, and no players are coming into this business. So they can actually generate higher profits. And they, when I look at kind of there are only 3 key players in this business, and only one of them, which is Johnson Matthey, invested in a plant in China. And that's where I think they're getting most of the opportunity. But no one knows what happens beyond 5 years. Maybe battery electric vehicles will much faster in that time period. So in that case, so I kind of run a case where the business just keep going down 10% every year post kind of 2030 and see what the value is in terms of cash flow. And that just gives me comfort that even if that happens, the company will still, that part still worth, like the auto catalyst itself still worth 3 billion in terms of cash flow. So I think that's where I'm getting comfort. But in the next 5 years, I think when I compare my forecast with what the market is forecasting, my forecast is still up, I think, 10 to 20%. So I do think that market is not fully pricing in the tightened regulation emission. Plus, in the longer future, I think the cash value of the business is protecting the downside of this business.
Thanks. Okay.
Okay, great. Thank you so much, Eric.
Thank you.
Next up, we have Joe Lee. Joe, whenever you're ready, you can go ahead and get started.
Great. Can everyone see that?
Yep.
Awesome. Well, thank you everyone for having me tonight. It's an absolute honor to pitch to everyone. So today I'm pitching a short on C Limited with a 2-year target price of $121, negative 27% IRR. So C Limited is a darling of the growth community because it checks all the boxes, right? Explosive growth, big name investors, and an outsider CEO with a Stanford MBA. This is exactly what Wall Street and Silicon Valley loves. However, my fundamental research revealed that C is unlikely to keep up with these lofty expectations in both key businesses of gaming and e-commerce. So the company obviously has had fast growth over the last few years. And since 2018, it's been the exclusive distribution arm of Tencent's games in Southeast Asia. So it runs one of the largest Southeast Asian e-commerce companies as well by gross merchandise value or GMV, and a heavily loss-making e-wallet business. So of course, both gaming and e-commerce are sexy, fast-growing businesses, but I believe both are structurally disadvantaged. First, the company is being priced as a gaming developer on inflated margins. Gaming is a hot industry, but my research revealed that C is not really a developer, but a publisher with an outsized dependence on Tencent. And as for e-commerce, where efficiency and unit economics is what really matters, the company has instead relied on large subsidies to win share, but the strategy is unsustainable for the long term. There's also a lack of synergies across businesses, and the company lacks a cohesive growth strategy. So all of these issues added together leads me to believe that this is a compelling short. So Garena is C's $3 billion revenue gaming platform, which is what the company uses to fund growth in the other businesses, as it generates 200% of total EBITDA. So some of the parts reveals that Garena is being valued more than EA to date, and it's the #2 largest gaming company in the US. But despite this high valuation, with 60 to 70% of revenues coming from Tencent distribution contract, this contract actually expires in 2023, which invites the risk that Tencent will take more of the spoils over time. So how can C diversify away from this, right? And the answer is they have to develop their own games, and they have in a game called Free Fire. So this is Garena's game on the left. That is unfortunately a direct copy and paste of one of Tencent's video games, PUBG Mobile, with dumbed down graphics so it can be played on weaker mobile phones. So it's far too early to consider Garena a successful developer with just one game. Now, Free Fire was released in late 2017, and while the game is a hit right now, these hit games generally last 3 to 5 years at most. And we're about halfway through that life cycle, and revenue growth is starting to slow. In fact, this is the first time in 11 quarters where Q-over-Q revenues could potentially slow down. And while revenues could re-accelerate, it's not the eye-popping 30% that we've seen previously. And in fact, revenues were already slowing down late 2019 before COVID. Despite this bull case way overestimates gaming TAM due to Free Fire, the chart on the right, per the bulls, Garena will have 671 million users by 2022. I mean, this is close to 90% gamer penetration in Southeast Asia, Brazil, and India combined. So I find this very unlikely. And now Garena is being valued using EV/EBIT multiple. EBIT margins, which jumped in the last 2 years, should normalize if C eventually wants to become less dependent on Tencent, because they'll have to pay development costs that are very expensive, which is why best-in-class comps like Activision or EA are all around 30 to 35% margins. Otherwise, C continues to be tied to the Tencent contract, which we know expires or could get renegotiated in 2 years. So it's a tough spot to be in. And now moving on to Shopee. Shopee is the top 2 player across most of its regions, but how did it get there, right? They raised capital, they bought share with 0 take rates, and they continue to buy share to date. This is why GMV jumped, which has bolstered valuation, since the valuation methodology is a multiple based on GMV. Now, to justify this methodology, bulls like to equate Shopee to Alibaba or Mercado Libre, but unlike these peers, Shopee seems to lack an obvious operating mode. For example, Shopee has largely not invested in infrastructure, And per VAR, in Indonesia, the largest market, they're about 2 years behind Lazada today, which is their main competitor, who is owned by Alibaba. And they're 2 years on shipping unit economics. So I wanted to find out why someone would use Shopee over a competitor or vice versa. And per VAR, according to both customers and former employees, price is the key thing that matters, very little else. And even on top of this, another challenge that unit economics is that unit economics do not make sense in Southeast Asia because of the tiny basket sizes, right? At average $10 per purchase, shipping is $1 to $2. So take rates would have to be 15–20% to break even. But currently, take rates are all kind of throttled around a similar percentage, making large jumps in those take rates difficult to achieve. Now, if there's no brand loyalty and customers are focused on price, it's hard to justify a higher take rate. And really, it becomes the worst case scenario in game theory. If a competitor drops prices, you have to do it as well. Everybody loses. And payments, where Alibaba and Mercado Libre has carved out as their moat, this industry is also really competitive in Southeast Asia. There's already entrenched players like Grab and Gojek. More importantly, there's a number of entrenched banks as well. So this is why customer acquisition costs for paying users has spiked as those customer growth numbers have slowed. Now, beyond just the business segments, there's also a lack of cohesive growth strategy. So for example, Amazon was touted for its strict cost controls as we were building out, but there's a jarring lack of cost controls at Sea, right? So there's mind-boggling, indiscriminate hiring from 5,000 to 30,000 employees in just 4 years. And again, Sea doesn't have very many warehouses. They just started building those out last year. So instead of investing in lasting, scalable tech, Sea has been hiring cheap labor to do admin work. This is why it leads to extremely high turnover. As per one of my bar contacts, when she joined her team in Malaysia, on the very first week, 5 people on her team left. So it doesn't translate into a sustainable culture either. So moving on to Shopee's landing page. So there's 8 different regions at the bottom, right? And in 2019, they expanded into Brazil, where they're directly challenging both Amazon and Mercado Libre, both that are much better operators. So this to me is a red huge flag because it shows that management lacks the understanding of the circle of confidence. So that to me is very concerning. And it seems like management's playing the GMV growth game. Keep jumping into new regions and the GMV will be higher theoretically, and their valuation should theoretically follow. And just a little bit more on Meli versus Shopee in Brazil. So Shopee is again trying their strategy of subsidizing sellers to try to win share. And in fact, Meli's shipping is about 5 to 10 times faster right now. So without significant infrastructure investment, this is already a lost battle. And Shopee isn't really known to invest in infrastructure. So lastly, based on valuation, based on market-based valuation heuristics, I get to a minus 46% over 2 years at a minus 27% IRR. The bigger picture, however, is that sell-side consensus has this EPS inflection in 2022, and valuation implying that there's significant EPS growth in the out years to reach a reasonable exit multiple. But given low basket sizes and high variable costs in e-commerce and a normalizing gaming business, I find this bull case very difficult to be realized. So given my downside catalyst trigger in about the 2022-2023 timeframe, I recommend putting on the short late 2021. And with that, I'd love to open up for questions.
Thanks, Joe. We'll turn it over to the judges.
Joe, it's Carl Kawaja. Thank you. Fantastic presentation. And as you know, I'm one of the largest shareholders of this company. So I read your presentation with great interest. And I have sold a bit of it of late. So, we're not polar opposites on this. But one thing I wonder about with kind of Free Fire and then Free Fire with Shopee is, where I kind of might disagree with you, is like, to what extent did you think about, like, is Free Fire a game or is Free Fire like a metaverse? Because I sort of think, you know, they got 500 million users now. People play it, I think, an hour or two a day. Like, people are spending 1 billion hours a day on this thing. Like, and my understanding, although I'm not a huge gamer myself, my understanding is that, like, sometimes even if the graphics and stuff aren't that great, people want to go to games where there are like other people and other challenges. And so it kind of, it's its own reward, and it doesn't get displaced, because even if like you invented a better game, I'm not going to go to your game because, like, who's playing Joe's game, you know? It's like a popular party. You want to go to the party that everyone else is at. What do you think about that?
Yeah, that's actually a great question. And I've thought about this a lot because the concept of the metaverse seems very interesting, very sexy. I apologize for the sirens. I live right next to the hospital, next to Columbia. So I think one thing that I want to point this to is World of Warcraft, right? So the idea that metaverse, it's this gathering place where you have a lot of gamers to spend time and you exchange interests and you talk. World of Warcraft was the original metaverse. So it was when people can go online, spend a lot of time, role play, do whatever they want, and not just play in a battle royale format like Free Fire is right now. So I think that this idea of the metaverse is potentially a rehashed version of what we saw a decade and a half ago of MMORPGs being extremely popular for gamers. So I think this concept is interesting, and if they can continue to build up, if C can continue to build up a community, and it does draw out the life of a game. So World of Warcraft, it's still one of the most played video games to date, although about half of, or maybe a third, where they were previously.
That's helpful. And I guess the other thing I'm sort of struck by, sorry, I don't mean to ask too many of the questions, but I feel like having a business, admittedly a much lower PE business, which I have no disagreement with you that the game business is, kind of strategically allows them to fund another business, which to me feels like kind of a strategic advantage. Like, if you believe that Shopee is building a system and an infrastructure, like, I'd rather them do that with something else to fund it than kind of do it on their own. And I feel like I used to own Tencent in the early 2000s, and I, you know, stupidly sold it, you know, in like 2008. And, you know, Tencent was kind of seemed very similar. Like, they had a game business that produced a lot of money, but no one thought was worth anything, but it allowed them to invest in something else, which, you know, now inarguably is super valuable.
So the question is Shopee potentially building out something that is sustainable long-term?
Yeah, or is there, you say there's no synergy between the two, but in a way there is a synergy, because like you make money with this hand and then you invest to make money down the road with this hand.
Yeah, and I think that's a great point. And I think so I've thought about this as well. So yes, they are using one platform to feed another, but where I did a lot more analysis is how sustainable is that new business that they're investing into. So as I mentioned, they're not really building an infrastructure, right? So their unit economics are not very sexy right now. Revenue per purchase is slowing down on the Shopee side. And the reason why, it's because of this. So most of their items that they're selling are the FMCG items. So they're lower ticket priced, but they still have to pay the same amount for a kilo to be delivered or a package to be delivered. So that's cutting into where that terminal profitability turn is. I'm modeling this to be around 2027, but it could be actually further out. It really depends on when they decide to go full force with infrastructure. And why I think infrastructure is so important is JD.com. JD.com, they're winning in China in the tier 1, tier 2 cities right now, even though Alibaba went into a mode attack mode about 3 years ago, trying to subsidize electronics, which is what JD was really, really good at. And as we can see here, even though they tried to subsidize, they're not actually successful in doing so.
Thank you, Joe. Yeah, I want to let someone else ask a question. Sorry.
Hi, Joe. It's Paul Sonkin. Good to see you again. Question that I had, you've done a lot of really good research. What assurance do we have that this isn't already priced into the stock? And kind of what's the bull case? And like, why is the bull case wrong? Like what is the market missing?
Right. And that's
because if the market believed the fundamentals, the stock would be a lot lower. So it makes me, question.
Yeah. So where I think the market is coming at this through speaking with sell-side research analysts as well as certain buy-side ones is this comparison here that somehow Indonesia. So the heuristic that I see often used, which is, all right, where is C going to be? All right, Southeast Asia, that's going to be like China 10, 15 years ago. And let's look at how China developed. And because of that, we can figure out maybe whether it's basket size increases, per capita income size increases. This is, to me, a faulty comparison because, first of all, Indonesia, it's going to be a big piece of the pie. Sure, I agree with that. But I mean, if we can see where a lot of the investments had come through and why a JD or a Alibaba has been able to be so successful previously, it's because they leverage off of an already existing infrastructure network that the Chinese government built out. Chinese government spent about $15 billion on infrastructure. And because of that, they were able to get those delivery costs, that $1 per purchase for a shipping item down to almost de minimis costs. And this is not happening in Indonesia. This is happening in maybe Vietnam, Thailand to some extent, but some of the other countries where this heuristic is being put on, it's not happening. And this is what I believe the market is making a jump to, and it's a fallacious jump.
All right, thank you, Joe. Last up, we have Tim Lechleider. Tim, whenever you're ready, you can go ahead and get started.
Great, thank you, Meredith. Let's see. Yep. See, is that working for everybody? Am I full screen?
Yep, we can see it full screen.
All right, great, thank you. Okay, judges, thank you so much for having me here today. My name's Tim Lechleider. I'll be pitching Strategic Education as a long with 43% upside. Strategic is a $2.2 billion market cap operator of 3 for-profit universities, 2 in the United States and 1 in Australia. I believe we have the opportunity to invest in this business at 60 cents on the dollar today, as the street has overreacted to a nightmare guide on new summer enrollments and increasing regulatory concerns as we approach the election season. My thesis at a glance is that Strategic is well positioned to benefit from a cyclical recovery that's already begun, that the regulatory risks posed by the Biden plan are boundable, and that COVID has catalyzed improvements in this business. So as I mentioned, Strategic operates 3 different universities. Strayer and Capella are the US-based universities. They're both primarily focused on an online learning mode. Strayer educates around 55,000 students, 90% of them are part-time and 80% of them are focused on undergraduate degrees. Capella educates around 40,000 students with 75% of them part-time and around 75% focused on graduate degrees. Torrens is the most recent addition. It was a 4Q20 acquisition and educates around 12,000 students on campuses across Australia. So as we all know, trends in higher education have been pretty challenging over the last decade. There are debates around value going on in every corner of the country. And after decades of growth, we've really seen a stagnation in enrollment since 2010. For-profit has not been immune from that. It's been hit pretty hard, but very unevenly. I'd like to point out that we have around 50% of the for-profit universities in the United States today versus where we were back in 2012. And that's really been a story of institutional closures that have targeted bad actors, Corinthian colleges and ITT Tech being sort of 2 of the sort of poster children. Strategic has had a very different experience over the last 10 years. They suffered through the first third of the decade, but have inflected positively since by focusing on vectors that they can win, namely online. As you can see, around 95% of courses are taken in online mode today, and providing student value. Strayer is 15% cheaper than it was a decade ago, whereas even a public two-year degree is 30 to 35% more expensive. As a result of these factors, we've seen enrollment growth inflect positively, and Strayer has grown at a 5% CAGR since 2013. The emphasis here again is on value and online quality. FlexPath and Sophia are two initiatives that allow students to move through curriculum at their own pace and kind of improve that time to degree. The graduation fund gives students credit for completing their classes and reaching senior year, sort of a method to reduce churn. SEI Studios is about improving the online experience by partnering with documentary filmmakers, and Employer Solutions is about partnering with companies like Aetna and CVS to diversify away from federal financial aid. All in all, I think these are very logical areas to be focusing on in education in the 2020s. Moving into the meat of my investment thesis, my first point is that I believe the cyclical recovery that's already begun minimizes the impact of that minus 28% print on 3Q new enrollments. So in order to understand why the reaction to that print was so violent, I think we need to take a step back and see what this business was perceived as. This was historically viewed as something that was very countercyclical, driven by the fact that they averaged plus 20% new enrollment growth from 06 through 09. As a result, as you can see in this chart here, we really greatly outpaced the 2Q recovery before that surprising guide, which drove a very strong negative sell-off. In reality, however, the outsized growth from 06 to 09 was driven by the fact that Strayer doubled their campus footprint. They went from around 40 to 80 boxes in that time. So it was sort of a story of new capacity coming online. In reality, new enrollment growth has a minus 0.8 correlation with unemployment when viewed on a one-quarter lag. This is really a macro story. So my variant view is that the market was overly optimistic on strategic through the first half of the year and has now fled at precisely the wrong moment. The cyclical recovery is in full swing. Unemployment is down to around 6.5% as of December. We got further fiscal stimulus on the wings, and vaccine news is all positive. As a result of these views, I believe the street is overly bearish on future enrollments. Taking a step back to look at that minus 28% data point again, I think that's been oversold because I've gone through and built out kind of the churn model, the cohort model, all the way back to 2013, which has led to a couple of views. First, total enrollment is something that's built over a dozen cohorts and is several years in the making. You can see that continuation rate is something that drives long tails in enrollment. Next, the third quarter miss came in the summer term, which is the smallest, and I estimate just around 18% of enrollments. Combining that with the cyclical improvement that we've seen leads me to believe that strategic will bottom out on new enrollments in the third or fourth quarter of 20, and that we'll be back to total growth by the first half of 2022. And as a result, I'm 3 to 5% above consensus on enrollments over the next 6 quarters. Moving into the regulatory picture, the first thing I'd like to touch on is that I believe strategic is an experienced operator and very comfortable in the current environment. There are two major metrics we need to be aware of here. They are 3-year cohort default rates, essentially the percentage of students defaulting on their loans within 3 years, and the 90-10 rule, which simply states that schools can't derive more than 90% of their funding from federal financial aid. As you can see, these are both, there's plenty of headroom here. These are rules that the universities are very comfortable operating within and are sort of table stakes for operating in this industry. I'm obviously very aware that I'm pitching this immediately following a blue sweep. So let's talk about the Biden plan. I think the Biden plan is extremely boundable based on the 2015 and 2016 actions of the Obama administration. That's great coming from me, a lot better coming from Biden directly. And this is his platform straight off joebiden.com. You'll note that the first action item that I've highlighted in yellow here is a return to the Obama-Biden borrower's defense rules. Let's double click on that. These rules are familiar territory. This is the main legislative thrust, which really drove that shutdown of those bad institutions, those bad actors about half a decade ago. And there are really two major tenets here. The first was the borrower's defense to repayment, which gives students the ability to seek a defense against a university that has misled them in enrollment. And the second is a debt to earnings covenant, which essentially ensures that students aren't borrowing too much for the earnings they're able to generate after graduation. These rules were actually active and in place from 2016 until December 2019, when the Trump DOE got around to repealing them. The 2015 cohort was actually tested and released, and all programs across both universities passed. Further, default rates have trended positively in the interim years, and I believe that's highly likely to be correlated to debt to earnings ratios. As a result, I really believe this is sort of just another rodeo with the same rules that have been in place for the better part of the last half decade, and not, the beginning of a new regulatory regime. There is one new rule that the Biden plan calls out, and that's closing the 90-10 loophole through which veterans funding, VA funding, doesn't count towards that 90%. I've gone through and pulled some data together from the company's filings as well as the Department of Education. And the takeaway here is that I believe the schools have room to 3 to 4x the percentage of their students that are veterans before they run into any sort of issues with the 90-10 loophole. One last point I'd like to make is if you take a look at Strategic, Strayer, and Capella compared to some of the more predatory universities that have been shut down, there's clear differentiation here. The 3-year cohort default rates are much lower, the median earnings are substantially higher, and the 2019 outcomes are better than the 2014 outcomes. This isn't a university that sort of slipped through the cracks. I really do believe there's a strong value proposition here. My last point that I'd like to touch on briefly is that I believe COVID has accelerated some opportunities across the business. First, the Sophia online learning platform is an online subscription platform giving students access to gen ed credits for transfer to up to 2,000 universities. I think this is potentially a source of $11 to $17 million of revenue uplift for 2021 and potentially an interesting longer term growth driver as well. And on the cost side, I think real estate rationalization, management has guided to about $8 million of savings, which is 20% of rent. I think that's pretty soft given that they have 80 campuses across the Southeast and that we could get another $6 to $10 million of run rate savings by closing some of the larger footprint traditional pre-GFC buildings, though I haven't factored that into my base case. In terms of risks, there are 2 sort of political edge cases I think are worth being aware of. First is free college for all. There's still some legislative hurdles to this, and it's kind of been ways off, I believe. But if it did come to pass, I believe it's more likely to impact Strayer, but still is kind of a fundamentally different value proposition than these universities. The other would be student debt holiday. I think this is more likely to happen, potentially something that could happen via an executive order, but again, is unlikely to have much of an impact on these universities. One opportunity that I'd like to touch on briefly is that I believe there's a real chance for us to unlock some value off the balance sheet here. This is a business that has historically targeted $10 to $12 of cash per share for regulatory reasons, but has regularly been 50 to 100% above that. Today, we've got a pretty interesting activist involved. Inclusive Capital, which is Jeff Ubben's new fund, ESG-focused Successor to Value Act, has about a 5.5% stake in the company. We've also got a management team that expanded the buyback pre-COVID in 14-19, and I think there's a real opportunity to create value given the current dislocation in prices. Pulling all that together, in my base case, I've got 40 to 45% upside in this name. I think they can do around 790 of EPS in 2022, bouncing off the cyclical trough of 2021. And I valued that at 16 times earnings, which is the midpoint of the 17.5 times multiple this business has gotten over the last decade, and the 14.5 multiple it got during the second Obama term. I also think we've got really attractive upside downside profile here. In my bull case, I've got the company buying back 5% of shares outstanding, and that drives around 80% upside. In my bear case, I have this being a more protracted slump, Strayer continuing to print minus 20% new enrollments and seeing some serious pricing pressure. And in that case, I've only got around 24% downside. So I think all in all, pretty attractive asymmetrical investment opportunity. Thank you so much for taking the time to listen to me today, and I'm happy to answer any questions judges may have.
Thanks, Tim.
I had a question. Why was there a bifurcation in new students between Capella and Strayer? Why did Strayer drop so dramatically in the summer quarter while Capella, I think, grew by 4%, right?
Yeah, it did. So the main driver there was that Capella was primarily serving a cohort that's a little bit older, a little bit more work experience. They tended to be a lot more able to work from home and kind of continue to get that steady paycheck. Strayer students are younger, a little bit less experienced, more sort of frontline jobs. In the immediate wake of COVID, a lot of them, were furloughed, laid off, and weren't able to kind of keep that paycheck coming in.
Okay, thanks.
Tim, hi. I by the way, I just wanted to thank Joe Lee to have the fortitude to offer a short selling idea. Alex Porter would have appreciated that, especially in this environment. Tim, this was really well done.
Yeah.
We at Amici, we were short for-profit education for years. How do you think about the long-term fundamentals here? I mean, obviously, you noted Inclusive Capital, and I'd like to think they vetted the morality of the business model, so to speak, the changes you spoke to in terms of basically more value. How do you think about the long-term potential here? And you mentioned the 16 times multiple. I mean, it's very cash generative. I mean, could you have a much different target longer term, or what's the puts and takes at longer term, assuming the regulatory is not an exogenous shock?
Yeah, that's a fair question. I think I do think this is fundamentally a lot better of a business. I think for-profit is a much more investable theme than it was probably a decade ago. Like if you look at the behavior of some of the actors who have been closed out, it was like leaving students that no longer had a university, just totally out in the cold. It was raising prices 5% every year for a decade straight through the 2000s. These businesses are frankly a lot less profitable than they were a decade ago, but it's much more sustainable at the level they're at. I don't really see any reason Strayer and Capella couldn't continue to grow at GDP plus a point or two over the next few years. I think that there's sustainable differentiation in terms of the online offering and the ability to serve students who are historically kind of underserved within that. And I think Torrens is a really strong asset. It's shown pretty incredible growth over the last half decade. I pitched this mostly as sort of, a cyclical view over the next 18 months. I do think there's some reasons that this could be exciting over the longer term. One other that I just very briefly like to touch on is the employer solutions side of the pie. I think that this business becomes a lot less fragile if they can boost that share of employer enrollment. And that's something they've talked a lot about doing. They're actually tying it to executive comp beginning next year. It's around 20% of students today, and they've got a target of 30% of students for next year.
Yeah, that was in the air years ago. Is that 20% increased much?
No, it's been pretty stagnant over the last 5-ish years.
Okay. Okay, thank you.
And can you talk a little bit more about that? Just because I don't know much about this industry, but free school for all is a compelling price proposition, but it's not a compelling price proposition if it doesn't get you a job, right? So help frame for me how well this competes with free public education in terms of actually getting people jobs. How do we think about that on a relative basis? Thank you.
Yeah, sure thing. So I think one thing to keep in mind here is free college for all today. We're not talking about, your average state school becoming free. It's really focused on kind of the 2-year community college and then potentially leveraging that as sort of like a 2+2 model. I think that Strayer and Capella are pretty differentiated from that because for one thing, Capella, I think, is in sort of a totally different ballpark, right? We talked about 75% of their students are pursuing advanced degrees. I don't think you can really free college for all that market away. Strayer is more likely to be impacted, but they have a couple things going for them. The first is that, this is a 4-year degree. You're coming out with a bachelor's. Only 3% of their students are actually pursuing those associates. And the second thing is, I think the strength in online education is a pretty big differentiator for them with the cohorts that they're serving, primarily because these are people, the average age of Strayer is around 34. Like I said, 90% of them are going to school part-time. This is very much going back to further yourself, to build on the education you may already have and to better your circumstances. So I think the online is something that enables people to be able to kind of manage those dual responsibilities in a way that, a 2-year associate degree isn't going to be able to.
Great, thank you.
What's the biggest risk?
The biggest risk, big picture, the biggest risk is, they step astray of the regulators, right? Like that would be the biggest issue this business could have. I've walked through the reasons why I think that's extremely unlikely. In terms of things that are sort of on the table, I put free college for all here. I think that is the one where, that gets passed. You wake up the next morning. I don't really know what to tell you. I don't know what to tell you that the stock's going to do, right? To me, that's the one that sort of is a bit of uncharted territory.
Yeah, headline. That's as they say, headline risk.
Yeah, exactly.
Quick question. Can you just talk a little bit about their sort of student recruitment practices? I recall that there were really kind of unsavory practices across the board.
Yeah, that is very fair. That's actually part of the current regulatory environment. You used to be able to pay bonuses for student recruitment. Essentially, people would be able to, just get paid for signing up anybody off the street. That has been legislated away. The school recruits kind of through all channels. They do a lot of career fairs, a lot of referrals from current students, college job fairs, things like that. And they also do a fair amount of digital advertising. It's a very modern approach as well. They call out kind of online recruiting as the biggest driver of enrollments today.
Great. Thank you, Tim. So time is up. The judges will now deliberate in a separate Zoom room. So if the audience can stay on, we'll be back to announce the winners in just a few minutes. Julia will put up the hold slide until then, but stay here because we are coming back. Thanks so much.
Okay, we're back. Well, thank you everybody for attending, and as you can tell, the presentations were terrific. The investment ideas were good investment ideas, and as you can tell by the duration of how long we were gone, there was a very robust debate and conversation amongst the judges as to who did the best job. It wasn't an easy decision. The discussion encompassed both the quality of the idea, the quality of the research, in addition to the quality of the presentation. And I want to thank the 4 finalists, Amitaabh, Eric, Joe, and Tim. You all did a very good job. The winner is Amitaabh Sahai. DXC, over the several rounds of votes that we had to determine who the final winner kept on coming up again and again and again after several debates. So thank you, Amitaabh. You did a great job. Congratulations. And thank you, the audience, for listening in today. We appreciate it very much. And hopefully we will see you all next year.
Congratulations to Amitaabh. David, thank you again. We really appreciate it. Thank you so much to the judges and the audience members. We hope to see you all in person sooner rather than later, but we will also hopefully catch you online February 4th and 5th for the 24th annual SEMA conference. In the meantime, have a terrific weekend, and thanks again to all.
Bye now.
Great job, everyone.
Thank you very much, everyone.
Great job.
Great job, everyone.
Thank you.
Thank you.